Go ahead, please. What is translation? Hello.
Hello, sir.
Yes, I'm listening now. What is translation? What is definition term?
I would say it's conversion of foreign currency to local currency.
Okay. Another person. Another person, please. Nobody want to talk. Okay. Translation. So when you say conversion, you really try. That is translation. But we can see it from this perspective that translation, it is the restatement. When you restate, are we there?
Yes, sir.
Hello.
Yes, yes.
So translation, it is the what? Restatement of account balance. When you restate the account balance or you restate the financial statement of a foreign operations into naira. Do you get it now? That's what I mean by translation. You reinstate, that is, it is the restatement of account balances or financial, when you restate the financial statement of a foreign operation using what is called appropriate exchange rate. Using what is called what? Appropriate exchange rate. And when they say using appropriate exchange rate, I can say that this art that we are talking about is not involving the changing of one currency into another. Not that we are changing one currency into another, but we are just saying that we are restating it. We are restating the account balances or financial statements of a foreign operation using what? The appropriate exchange rate. Are you good to go?
Yes, sir.
Another thing that we also need to talk about under the definition term is called conversion. Who can try this as well? Conversion. Who can try, please? Conversion. My people, is it that you don't want to talk?
Conversion is
Hello.
the process of exchanging, of converting one foreign currency to another using appropriate exchange rates.
Okay, good. That is what they mean by conversion. It's just like when you express that is an conversion. It is what? Expressing a foreign currency. When you express a foreign currency, for instance, US dollar into naira, and you are using appropriate exchange rate, that's what I mean by conversion. Conversion is by way of what? Expressing a foreign currency, such as probably the US dollar into what? Into naira. Into naira by the use of what? The appropriate exchange rate. Thank you. Another thing that we also need to talk about is that of what's it called? Spot rate. Spot rate. Who can tell us? Who can try this as well? Spot rate. What is spot rate? My people, I'm waiting. Spot rate. Hello. Are we not available? Hello. I said spot trade. Who can try? Are we ready for this class at all? Let the class be interactive now, please. Spot rate.
Hello?
Hello, go ahead, please. Spot
Okay,
rate.
spot rate is the current exchange rate in which the account will be translated. That is the most current exchange rate that will be used.
Okay, thank you. That's what is for spot rate. But let us now restructure it properly. When it says spot rate, we are saying the current rate as at now. That is, we say it is what? The exchange rate of prevailing on a particular day. Prevailing on a particular day, we call it spot rate. The exchange rate as at now. So if I ask you that, what is the exchange rate of $1 to naira as at now? That is what I mean by the spot rate. Are we there?
Yes, sir.
Yes, sir.
That's what I mean by the spot rate. That is the what's it called? The exchange rate prevailing on a particular day. That is the exchange rate as at now. That's what I mean by the word, the spot rate. Another thing that we also need to talk about is that of forward rate. Forward rate. Who can try this as well? What is forward rate?
Hello?
Hello, go ahead, please. Forward rate.
Forward rate is the future rate.
Okay. God bless you. God bless you. That's forward rate. So forward rate, according to what the man have said, forward rate is a word, is an agreed. You put that word, the agreed rate. Forward rate is a word, the agreed rate. So if I said agreed rate, what I'm saying is that it is possible that, oh, I want to pay for my school fee. Maybe I'm doing a program with one university in UK, and I want to pay for my school fees probably December this year. And it's possible for me to go to the what's it called? All this bureau de change or the FS dealer that I need, probably maybe I want to pay in dollar, probably I need $20,000. If we focus or we are what's it called? We're on a contract and there is an agreed upon at that particular day that we sign. If the dollar, if $1 is in 1,005, then no matter what, if the dollar now maybe rise, maybe $1 as at that December that I will need that money. If $1 is 2,000, so I will not pay 2,000. I have to pay based on the agreed upon. That's what I mean by forward rate. So that's what I said. Forward rate is the word agreed upon now for future delivery. So there must be agreement between the two parties. That is myself and the FS dealer. There has to be agreement between two of us. So that's what I mean by forward rate. Even though if the exchange rate increases or decreases, whether it's favorable to him or whether it's favorable to me, so nothing will change it because it has already in a contract. That's why we said forward rate is a word, is an agreed upon. Now, the agree upon now, what the two parties agreed now for future delivery. Is it clear?
Yes.
Am I talking to one person?
It's clear, sir.
Okay. So another thing that we also need to talk about is that of exchange difference. Exchange difference. What is exchange difference? Who will help us with this? Exchange difference. Hello, my people. Are we tired? My people, are we tired? Hello.
No, sir.
No, sir, we're not done.
So exchange difference. What is exchange difference? Who will try?
Exchange difference is the difference that comes from the translation of a given number of units in a currency to another currency at a different exchange rate.
Okay, thank you. That's what I mean by the exchange difference. When you do your translation, we've already explained the translation. So when you do your translation, then you are talking about the result from that translation. So once we said the result from that translation, let us assume you are doing translation between one currency to another currency, maybe from dollar to naira or naira to CD or CD to dollar. Then you want to look for the exchange difference. So that exchange difference need to arise. Are you getting it? The exchange difference need to arise as a result from that translation of that foreign what's it called, foreign currency at a different exchange rate. So then the difference will now be what? Your exchange difference. Another thing that we also need to talk about is called closing rate. So what is closing rate? What is closing rate? Closing rate. Closing rate, please.
Closing rate is the spot exchange rate at the end of a reporting period.
Okay. Now, that is closing rate. So in other words, you can say closing rate. You can say closing rate ruling rate. That is the rate as at the balance sheet date. That is the closing rate. The ruling rate or the rate as at what? The balance sheet date. That's what I mean by the closing rate. For simplicity, that is the closing rate. Apart from the closing rate, we can also talk about, out of this other one, functional currency. We can talk about the functional currency. Functional currency. So what is functional currency? Functional currency. So what is functional currency? What is functional currency, please? Hello, please. Functional currency. Hello. Okay, in the absence of no response. When we say functional currency, I said I want the class to be interactive, please. If you are tired, just let me know. When we say functional currency, let me cite an example. If we have a company here in Nigeria, maybe our company name is ABC, and then probably we have a subsidiary in Ghana. So this is the one in Nigeria here is the parent company. Then if they now ask you that what is the functional currency of the company that we have in Nigeria here, what will you tell them?
Naira.
Naira. Then from there now, what is functional currency?
Can you hear me?
I can hear you.
Okay. Functional currency is the currency of the parent company.
Go ahead, please.
I said functional currency is the currency of a parent company.
The currency of the parent company, based on what we cite as an example. Good. So it means that functional currency, it is the currency where the business is what is operating, where that business is what operating. That's the functional currency. Is it clear? Is it clear?
Yes.
Yes, sir. Yes, sir.
Yes, sir.
Another thing that
Yes.
we also need to talk about, we call it presentation. Presentation currency. Who can try this one too? Presentation currency.
Presentation currency, I think, is the currency at which the financial statement is being presented in.
God bless you. Is that's all. Nothing. It's not as in nothing to add or to subtract. You can only say presentation currency. These are the currency in which the financial statement has been what prepared and presented. You are using it to prepare it and what present it. That's what I mean by presentation currency. God bless you. Another thing that we also need to talk about is that of monetary items. Monetary items and non-monetary. Monetary items and what? And the non-monetary. Non-monetary items. So who can try that? Monetary item. Who can try that, please?
Monetary items are things that deal with money.
Monetary item is what?
Things that deal with money,
Okay, example.
that are financial.
Example of monetary item is what? Example of monetary item is what?
Trade receivables, trade payables.
Okay, good. Trade receivable and trade payables. They are example of what? Monetary item. So what of non-monetary item? What's the example of non-monetary item?
Example of non-monetary item: inventory.
Is that
In,
go ahead, please.
inventory.
Producer,
Now we can say PPE, plant, property, plant, and equipment.
That- So they are what? Non-monetary item.
Item.
So thank you. So these are the terminologies that definition term of this foreign exchange operation. Then after that, we can talk about the movement, how we are going to account for it. So when we discuss how we are going to account for it, then that is where we can now think of what's it called? The group account under foreign operation. Are we there? Now, let's look at one illustration and let's see how we are going to account for this foreign exchange operation. I think we are tired, right? Because there is work tomorrow.
That's all in sir.
So let's say maybe on 31st March, let's say 2023. On 31st March 2023, a Nigeria company, based entity, sells goods to a Ghanaian based entity for what is sign of Ghanaian? CD. $550,000 CD. When the exchange rate was 1 naira equal to 5.5 CD. Are we still there?
Yes, sir.
Yes, sir.
Yes, sir.
On 1st of September, on 4th of On 4th of September 2023, the customer remitted a draft for CD 550,000 when the exchange rate was 1 naira equal to 5.5. I use 5.5 before. Sorry. Let me use this one 5. So 5.5. So required show the income and liability. So the income and what? Liability. Together with the exchange difference. Exchange difference. So this exchange difference can also be called exchange gain or loss. Exchange difference arising will be accounted for. Accounted for in the financial statement. Are we there?
No, sir, I didn't get the last part.
Hope you can see my screen. You can see my screen, no problem.
Yes, I can see your screen.
Okay. Now, who can read this question for us? Let's see the transaction. Who can read it for us? And let's see how we are going to go about it.
Okay, let me read. On 31st March 2023, a Nigerian company goes to a Ghanaian-based entity for CD 550,000 when the exchange rate was 1 naira 5 CDs. On 1st September 2023, the customer remitted a draft for CD 550,000 when the exchange rate was 1 naira equals to 5.5 CDs. You are required to show the income and liability together with the exchange difference arising will be accounted for in the books, in the financial statement.
Okay. So if you look at this transaction, you discover that two parties are involved. A Nigerian company and also a Ghanaian-based entity. Nigerian company sells goods to Ghana, the Ghana-based entity, right? And don't forget that if Nigeria sells goods to a company in Ghana, and the company in Ghana will pay, are we together? The company in Ghana will pay to Nigeria. And if he pays, he will pay CD, right? Then if he pays CD, don't forget that the company in Nigeria, they are not spending, our currency in Nigeria is not CD. It is what?
Naira.
It is Naira. It means that the Nigeria-based company will take this CD to what? To the forex dealer to convert it to Naira. Yes or no?
Yes, sir.
Yes.
So it means that we want to check whether at the end of the day, the transaction will favor, what was it called? The transaction will favor the Nigerian company when the transaction was made, and at the same time when the what was it called, the payment was received. That's what we want to do. We want to check that when the payment was made, when the transaction was made, which is the sales, and at the same time when the payment is what received. Hope you are getting it.
Yes, sir.
Now, if I'm selling as a on 31st, let's pay attention. On 31st March 2023. Now, if I'm selling, you get my point. You are selling
Yes, sir.
to a company in Ghana, 550 cedis. That is, you raise an invoice to them. That invoice cover 550,000 cedis. You know, in your book, you cannot keep CD in your book. You have to translate it to what?
To Naira.
Hello.
You have to translate it to what?
To Naira.
So, yeah, is the functional currency of that company that based in what? That based in Nigeria. Then if Naira is a functional currency, then the effect, the leg, the account that we want to prepare, the leg is that you are debiting, because when you sell to what's it called? The company in Ghana, what are you debiting? You are debiting AR. So what's the full meaning of AR?
Receivables.
Account receivables. You are debiting AR. So let me write it in full. Account receivables. You are debiting AR. Then with 550 cedis. But just that you want to convert it to your local money. It will now be CD, which is 550. Then as at that time that you made that transaction, what is the exchange rate? Then what is the exchange rate as at that time at the first month?
1 naira to 5 cedi.
1 naira to what? 5 cedi. I believe it's clear. So
Yes, sir.
now the logic is that, am I going to divide this amount with 5 cedis, or I'm going to multiply with 5 cedi?
You divide it, sir.
I'll divide it.
Yes.
Why am I dividing it?
So that you can know the amount in naira.
I can convert it to naira.
Yes, since 1
But
naira
what
means
of,
5 cedi.
yes, 1 naira will give us 5 cedi. It means that if I want to move, that is why the, how will I put it? The knowledge of SFM will also help here. If I want to move from local currency to what? To foreign currency. But this time around, I'm moving from foreign currency to local currency. Do you know the reason? The Nigerian company, the company that based in Nigeria, the local currency of that company is naira, because that is where you operate. The country that you operate, the currency that they are spending in that country is your local currency. It is the local currency. Then CD will be what? Will be foreign currency to him. Yes or no?
Yes, sir.
Yes, sir.
Then If I want to move now, if I want to move from foreign currency now to local currency, because 550,000 CD is a foreign currency. If I want to move to foreign currency to local currency, I will now say I'm dividing it. But let's assume I'm moving from what? From local currency to foreign currency. What will I do?
Multiply.
I will now multiply. So that is the yardstick about the movement of what? A foreign exchange. So what do you have?
That's 110,000.
So 110,000. So we are converting it to naira now. Imagine, you can see now that I'm moving from the foreign currency to my local currency now. That's why I'm dividing it. Then the second leg, which is you have to credit your revenue, which is sales in your book, because sales has to be what? Credited with the same what? With the same amount. I believe it's cleared.
Yes, sir.
Hello. It says 110,000. So that this is how you are going to treat the transaction on that 31st March when the sales was actually made. Then let us now look at when the money was actually received, because they said on 1st of September 2023, the customer now, who is the customer they mention here? Who is the customer they mention?
The Ghanaian customer.
Okay, so the Ghanaian now remitted a draft of this 550,000, but at the time that they remitted it, the exchange rate that time, it is now 1 naira to what? 5.5 CD. Is it clear?
Yes, sir.
Yes, sir.
Okay, as at that is on 1st September 2023. That is when the money. That's when the money came in, right?
Yes,
And
sir.
that
Yes,
time
sir.
the exchange rate is no longer 5, it is 5.5. So the account treatment is that, if they pay, they are paying to our what? Our bank account, right?
Yes, sir.
Yes.
Yeah, we debit bank, because money, we receive money, and as the rules imply, it's an asset. Bank is an asset, though it's the current asset, we debit it. So as money comes in, we debit it. Then, so our bank will be debited with what is it?
100,000.
550,000
550 grand.
divided by what? 5.5.
5.5.
Yes, because at that time, the exchange rate is no longer 5. It's no longer 1 naira to 5 CD. So what do you have?
100,000.
100,000. Imagine, this is our revenue, one thing. If you compare it with what we receive, the exchange difference, is it at gain or at loss?
At loss.
At loss. God bless you. It's at loss. So what is the second leg here? What is the second leg? We debit
Account
what?
payables. Accounts
Before we
payables.
get, okay, before we do that, let me, you know, I've already bring out the loss. Do you get it now? You said there's a loss, right? So it means that we have to debit that loss because that loss will be regarded as what? Expense. Is it clear? Which is exchange loss. Exchange loss to be how much?
10,000.
10,000. So exchange loss will be 10,000. Because if you compare your revenue, this is the invoice that you send to them in naira. Then at the time that they want to pay you, they now pay the same CD, but just that the exchange rate that time is no longer, the exchange rate is not 5 again, it's 5.5. So they pay 100,000 into our bank account. So automatically there's a loss. We made loss of 10,000 naira. Then the third leg, we have to be what? Credit what? Account
Payables.
receivables. So that it will nullify, you know, here there's a debit here. Account receivable is debit here, so that it will nullify here. The leg will just close. So account receivable will now be what? 110.
110.
So any question? Any question, please?
So sir, that loss that they made would just go like that. There's no how to rectify it. Would have to pay for that loss.
Yeah, that loss. That is the loss that we make. That's the loss. Because it is a win-win. Sometimes we can see it as exchange gain. In the sense that maybe when we raise the invoice, the exchange rate that time is 1 naira to 5 CD. But if they want to pay us, maybe during the time they want to pay, it's now become 1 naira to 4 CD. You know that we are going to this, you know, it is favors. So that's the work of the exchange effect of what's it called? Effect of a foreign
exchange operation.
Yes, that's the effect. It's either it will come in form of exchange gain or it will come in form of exchange loss. That is why if you are selling to your customer that is maybe is not in Nigeria, outside in Nigeria, and they are not paying you on time, at worst, if they want to pay you, probably 15 days, 1 month is even too far. Because at that time, the exchange, you understand, the exchange rate will be fluctuating. But if probably within 15 days credit, you can still be having no issue with the exchange gain or loss. But if probably you said to them they are not paying you on time, are you getting it? Because let's see now, how many months interval you are selling to them March, but they pay you September. How many months is that?
6 months.
6 months. 6 months is too long. Do you get it now?
Yes, sir.
Yes, sir.
Are we tired?
No, sir.
Go ahead, sir. Let's continue.
Okay, let's do. Though at the end of the day, when we are to prepare the group account, so we should be able to maneuver and understand how the exchange rate, is really, how we are going to play around the exchange rate, how the exchange rate is working. So let's look at another examples. Let's play with another examples, maybe example 2. On the On 21st April 2019, Cold Code Limited purchase goods from demand who based in London. From demand who based in what? London. For I'm looking for, it's not showing. That is what's this thing? Pound sterling, right?
Can be pounds, it can be euro.
Which one do you want us to put? So let's put pound sterling. How much do you want us to put? Pound sterling of let's say
10,000 euros.
Is it okay like this? On 13th of July,
Is it 1,200 or
yes, 1,000.
200 pounds?
1,200, 1.2 million.
Okay.
On 13th of July, 2019, Cold Code Limited settled demand in full. It settled demand in full. The functional currency of Cold Code Limited. Cocoa Limited is Naira. Cocoa Limited is Naira. The exchange rate. Are we tired?
Continue, sir.
No, sir.
The exchange rate follows Which exchange rate should I use for me? Follows. So let's say 21st April 2019. Let's say 1 naira equal to let me change this one to euro so that I will write it not long.
Are we using euro or pounds?
Euro. Then
Okay.
because that spelling is too long, so I want to shorten it. 13 July 2019. ₦1 equal to €12. So required others. They are sleepers. There is only one person that is answer me.
Let's
We are
continue,
awake,
sir.
sir.
Shows okay. Shows the expenses and liabilities. Liabilities including expenses and liability including exchange difference. Will be accounted for in the financial statements. That's what we will help us to read it.
On the 21st of April 2019, Coco Limited purchased goods from the man who based in London for euro 1.2 million. On the 13th of July 2019, Coco Limited settled the man in full. The functional currency of Coco Limited is Naira. The exchange rates were as follows: 21st April 2019, 1 Naira to 10 euro; 13 July 2019, 1 Naira to 12 euro. Required: show the expenses and liabilities, including exchange difference that will be accounted for in the financial statements.
Okay, good. I think we can all do it, right? Can we all do it?
We'll try, sir.
Let's
Okay,
do it
good.
together.
Okay, that's good. I love that. So
We lost you, sir.
Listen, please kindly mute your mic. It's affecting others.
Hello. Please, pending the time he returns back, maybe we should discuss this together. Maybe we can get it solved. Can we all try it together?
Please, is anybody hearing anything from okay? Can't hear anything.
I think it should be network from his side.
His network or probably
Okay, just like Afolabi suggested, we can go on and try it.
No, I can't see the question. Are you seeing the question?
You didn't copy it?
Before I joined the link of it.
Can I read it out for you?
Okay, let me. Sorry, a minute. All right, you can go ahead.
Okay. On 21st April 2019, Coal Court Limited purchased goods from a man who is based in UK. Who is based in UK for €1,200,000.
1,200,000
€200,000. On 13 July 2019, on 13 July 2019, Coal could settle his account in full.
Okay.
Are you there? Okay.
Yes.
The functional currency of Coal Limited is Naira. The functional currency of Coal Limited is Naira.
Okay.
The exchange rate were as follows.
Okay.
On 21st April 2019,
2019.
the exchange rate is 1 Naira to 10 euros.
1 Naira
to 10
to
euros.
10. Okay.
Then on 31st July 2019,
Okay. The exchange rate is
1 Naira to 12 euros.
okay.
Okay. Then you are required to show the expenses and liability, including exchange difference. Exchange difference.
Okay. Okay.
in the financial statement.
All right.
In the financial statement.
Okay.
So that's the question.
Please, that the beginning, that beginning again, please, sir.
21st
On
April.
24th. Okay, April. Coco purchased goods from a man based in UK.
Based in UK. Maybe London. Anyone. Okay, Afolabi.
So I think for to for 24th April 2019, the treatment will be this. Then we credit payable. The man is the co-call is yet to pay. We debit the purchases with that 1.5, which is 120,000, right?
Yes.
Then we credit payables with 120,000. On the 13th July, when the man
How did you get the 120,000?
that 1.2 divided, I mean 10 euro. You know, he said 1 to 10 euro.
So that we understand.
Okay, do you understand?
Is 1 point, is
Yes, I
1.2
understand.
divided by 10? Okay.
Yeah, what she's trying to say is from the question, the two accounts that are affected are the accounts payables and the purchases account, since he purchased the goods on credit. So we are going to debit purchases account and credit accounts payables. Am I correct, Akvolabi?
Yes, you are correct.
Okay. So, and for us to get the actual amount, since we are transferring from the local currency to the foreign currency, so we are dividing. Am I correct?
We are translating the foreign currency to local currency.
Okay. Yeah.
So that is why we are dividing.
Okay.
Okay, when you are translating from foreign currency to local currency, you divide.
Yes.
Okay, they reverse the case. What if you are transferring from local to foreign?
I think we'll multiply.
Multiply.
It depends on, it's yet to explain that. It depends. I think it's the exchange, the foreign currency is higher than the local currency. That's why we are dividing.
Actually, what I think is it depends on who is reporting, who is preparing. If you look at in the first illustration, it was in the books of the Nigerian who sold goods. Still, we divided because the foreigner who is a Ghanaian, he paid too. And since the Nigerian based company is the one preparing the account, so we divided. So based to the base of my knowledge and to the base of my understanding, it depends who is preparing the account. Then you will know at what point either to divide. If you're translating, let's say from and to euro, we divide it based on the euro. If we are changing it to naira, we multiply it. We multiply the euro to naira to the best of my understanding.
Okay.
Correct. With 10.
Okay.
But we can continue now. So let's do it so that if there's any correction, he'll correct us when he comes online.
Alright. So that was for April 21st. Half out. Then for 2019, it's payables, account payables at 120,000. Then credit 100,000 divided by 12 euro was on
I didn't
1,000.
get you.
Now we want to pay. The man want to pay.
Okay.
Correct now. I think the code is reporting, that is reporting now.
We are debiting payables.
I think the cocoa is if man. No, it's cocoa that is paying, right?
Yes.
Then we put cocoa's bank account with one giving us
Which account are we debiting now? Which account are we crediting?
crediting bank account and exchange gain. Then we debit payables. Bless you, please say something.
Hello?
Hello.
Okay, what did you say?
I said something about the treatment.
In the treatment is we are debiting account payables with 120,000 and we'll credit bank with 100,000 and credit exchange gains.
With 20,000.
Yes, which is an income.
Yeah.
Aligwe.
Can you refresh? I didn't get what you say. You say
Did you get the
we are
first one?
crediting bank.
Yes, now
Yes, that's the
bank
one we
is
debit
paying.
for.
Bank is paying.
Credit bank with
100,000. 100,000. Yes, because if you divide 1.2 million all over 12 euros, it will give you 100,000.
Okay.
Are you there? Then since already we have credited account payables with 120, so definitely we are going to credit bank and credit income account, which is exchange gains. Am I correct, Afolabi? were able to show the income, the liability, and the exchange gains.
Naira.
Hello?
The exchange gain, exchange difference.
Yes, it's a gain.
Yes, it's 20,000 gain.
Yes. He bought it higher and he's paying lower.
Yes. So I think we can go since we didn't see him again. Maybe. Let's go. Compare is
It's like
solution.
you. Sorry, see?
I said probably next class when he solve the question, then we compare it with what we have done.
Yeah.
Yeah.
All right. Good night.
Good night.
Good night.
Good night, everyone.
Good night, everyone.